In this video, let us decode one of the most important and the most misunderstood concepts in finance, implied volatility. By the end of this video, we'll understand what it is and how it is calculated and why it's often called the market's fear gauge. First, let's get a handle on volatility itself. There are two main types. On one hand, we have the historical volatility. This is simple. It's how much a stock's price has moved in the past. It's a fact like looking at the stats after a game is over. On the other hand, we have implied volatility, or IV. This is the market's forecast of how much the stock's price will move in the future. It's not a fact, it's an opinion baked into the current price of an option. Here is the best analogy. Think of driving. Historical volatility is like looking in a rear view mirror to see how winding the road has been. Implied volatility is looking at the road ahead to guess how winding it's going to be. One is the past and the other is the future. So if we can't see implied volatility directly, how do we find it? We use the famous Black-Scholes-Merton formula. This model gives us the theoretical price of an option using 5 inputs: the stock price, the strike price, time to expiration, the risk-free rate, and finally sigma, which stands for the volatility. Now, here is the key insight. In the real world, we can see the option's actual market price on a screen. We know all the other inputs except for one, the volatility. So implied volatility is simply the value of sigma. We need to plug into the Black-Scholes formula to make its output match the option's market price. We are solving the equation backward. All right, let's see this in action with some Python. First, here, we import our libraries and define the Black-Scholes formula. Next, we create our implied volatility function. This is a clever bit of code that uses numerical solver to find the sigma that makes a formula's price equal to the market price. Now let's imagine a stock trading at $100. We're looking at a call option with 115 strike that expires in 3 months. The risk-free rate is 5%, and the option is currently trading for 2.50 on the market. We run our function, and then we get the implied volatility as 20.12%. This is the market's consensus forecast for this stock's future volatility. Now, the Black-Scholes model originally assumed that the volatility is constant for all options on the same stock. But is it really true in reality? Let's check it. We have a list of options here, all with the same expiration date, but different strike price like 90, 95, 100, 105, 110, and 150. And different market prices also like 11.50, 7.20, 4, 2.15, 0.95, and 0.4. We'll calculate the IV for each one. If the model's assumption is correct, you should get a flat line. So look at this. It's not a flat line at all. It's a curve or a smile. This is one of the most famous discoveries in the modern finance, the volatility smile or skew. This volatility smile or skew tells us that options with very low or very high strike prices have a higher implied volatility than options at the money. The downward slope you often see for stocks is because traders are willing to pay a lot more for options that protect against a market crash. The volatility smile or skew tells us that the option with very low or high strike prices have a higher implied volatility than options at the money. The downward slope you often see for stocks is because traders are willing to pay a lot more for options that protect against a market crash. So, why does all this matter? Implied volatility is crucial for several reasons. The first one is it's a sentiment indicator. High IV means fear and uncertainty. Low IV means the market is calm, just like the VIX index, which is just a measure of the implied volatility of S&P 500 options. It also tells you if an option is cheap or expensive. High IV means options have fat premiums. Low IV means they are on a sale. And finally, it guides trading strategy. When IV is high, traders often look to sell options to collect that rich premium. When IV is low, it can be good time to buy options. So implied volatility is much more than just a number. It's the market's collective forecast, a measure of fear, and a guide to an options price, all rolled into one. By understanding it, you can start to see the expectations and risks that truly drive the market.